The currency wars continue. Right now, I'm at quartz.com, and if you look at this title, absolutely everything you need to know or you need to understand what happened to the Swiss franc this week. The Swiss franc is a very popular place to park cash. Amid the Eurozone debt crisis, demand for the franc surged, pushing its value up sharply. If you look at this chart over here, the Swiss franc's appreciation against select major currency. If you click on it here, you can see the franc soars in value during the worst moments of the euro debt crisis. You can see over here, 2011. And if you notice during this time, also with the appreciation of the yen, you saw that the US dollar, not the US dollar, but gold prices started to soar at that moment. And then when you saw the depreciation of the yen and the depreciation of the franc over here, you started to see gold prices get slaughtered. So this is something to note. And now you see a reversal in the franc. So does this mean that we're going to see higher gold prices? Well, we shall see. I'm going to overlay a chart in future videos to show you any correlation, if there's any, with the Swiss franc. And then if you look at this over here, so the central bank put a ceiling on the franc's strength. September 2011, the Swiss National Bank set a limit on the amount of strength it would tolerate, vowing to use its power to print money and use that freshly printed money to buy unlimited quantities of foreign currency. The ceiling worked for a while. See, if you see this over here, September 2011, S&B sets a ceiling on the currency, hammering it lower. Gold topped out right around that time, September 2011. But there was a problem. Because it was creating new francs and using them to buy euros, the S&B's currency holdings exploded. This is hugely important. In the United States, the Fed is buying the safest financial instrument in the world, U.S. government bonds. It can hold those bonds until they mature and be virtually assured it will be paid back. The S&B, on the other hand, is acquiring a giant pile of currencies that can whipsaw in value, potentially exposing the bank to large losses. Swiss National Bank holdings of foreign currencies in francs. September 2011. Currency holdings surge as S&B sets franc ceiling. But that isn't the same thing the Fed is doing. No, it's different. The Fed is creating money and buying U.S. government bonds. The S&B is creating money and buying foreign currency. In part, that's because the S&B is specifically targeting the rates, because it's also because there's not enough outstanding Swiss debt for the bank to buy. And S&B's currency bet is huge. The bank's foreign currency holdings have grown to about 75% of GDP. If you could look at this graph over here, the S&B currency holdings as a share of GDP in 2011 was a little over 40%. 2014 was over 70%. That's a huge amount. So the S&B decided to abandon the ceiling on the franc, which I believe is the correct decision. That's what it had just announced. In response, the spring-loaded franc shot higher. You can see. The decision caught markets totally off guard, in part because the rationale for the move is very tough to understand. After all, the strong franc will hurt the economy, as performance of the Swiss stock market this week suggests. And likely means Switzerland will sleep deeper into deflation. So, long story short, the Swiss decided to surprise all market participants, or many market participants, in getting rid of the peg to the euro. And a lot of these traders and hedge funds got short-sighted, and as a result, they have to deal with their bad bets. And ultimately, some will go bankrupt and lose their shares because of that. Okay, so now I'm over at Robert Wenzel's site, and he also wrote about the Swiss central bank move. Let's read a little bit of what he said. The title is Understanding the Swiss Central Bank Move and Its Implications for the Rest of 2015, a Guide for Dummies. Okay, so He goes here. So why are some financial firms taking huge losses because of this move? Because of something known as the carry trade. With the S&P printing so many francs, interest rates based in francs are very low. Thus it made sense, if you thought this policy was to continue, to borrow low interest rate Swiss francs and buy currencies where interest rates were higher. Bloomberg explained in early 2014. The Swiss franc is offering carry traders some of the best returns in developed markets. Switzerland's 0 to 0.25% target rate makes the franc a natural funder of carry trades. Its credentials may be further burnished by the 1.2 per euro cap the Swiss National Bank imposed in 2011. If you're to fund a carry trade in the Swiss franc, the funding slide would work out pretty well for you because it won't get stronger. Steve Arrow, the London-based head of Group of 10 Research at Standard Bank PLC, said by phone on January 15, 2014. Barrow recommends selling the franc against the dollar, euro, and British pound. The trade worked until yesterday. Then it went very bad. Think about it. In order to make decent money on this trade, you need to be highly leveraged. On top of this, you were short Swiss francs, which climbed yesterday as much as 40%. That is, in order to pay off your Swiss franc obligation. Yesterday it cost you as much as 40% more than the rate at the time you borrow the francs. And because traders employing this method are highly leveraged, they were likely getting margin called yesterday to put up more money immediately or face immediate liquidation. The liquidations were massive, with traders suffering losses so huge that some will be forced to shut down. That's why we are seeing foreign exchange brokers reporting massive hits. You can be sure that these brokers have underlying clients that also have huge losses. Bottom line, what is seen regularly in markets is that traders, instead of understanding the fundamentals of the situation, trade as though current trends will continue forever. With those trends reversed, the losses are enormous. Because most markets are rigged by central bank manipulations, the potential for all kinds of reversal in trends is possible. Although no trader believes these trends can be reversed quickly, but when everyone believes they can't and the trend does reverse and the shift is recognized, it happens very quickly and the losses are massive. Currently, I'm in a very small minority who does believe that fundamentals will ultimately result in very rapid price inflation and much faster hikes in interest rates than almost all expect sometime by the end of 2015, because no one is expecting these things to occur. The bloodbaths will be as bad as the Swiss franc carry trade bloodbath we saw yesterday, if not much worse. The year 2015 will be the year of bloodbaths. The Fed and other central banks have simply pushed their manipulations to the edge, and they will be forced to reverse direction because of market pressures, in the same way the S&P was forced to give up its propping up of the euro. When this occurs, and traders trading based on the current trends have to unwind their positions, financial markets will be rocked to the core. So what I find really interesting of what Wenzel is saying, he's saying that traders, they look at just simple trends, and they don't anticipate that these trends will reverse quickly. And because of that, what happens is they get caught in these highly leveraged positions, and then it's too late to unwind out of their position, because you have a move coming out of nowhere from the Swiss National Bank or an entity like that saying that, hey, we're going to get rid of a peg, while they did not warn anyone. I mean, if you looked at the news carefully, Christine Lagarde, head of the IMF, she said that she was quite surprised of the decision, that she wasn't told, this and that, because whenever you see a central bank make such a huge move like this, they usually notify the powers that be, and the powers that be notify all the big banks, hey, get out of this position ASAP, otherwise you're going to see problems like this. And what's really interesting is that Wenzel believes in fundamental analysis, and that fundamental analysis will always outweigh technical analysis in the long run. In the short term, you could get away with it, but if you're not properly hedged, and if you're a dumbass like these traders who are leveraged 50 or 100 to 1, and are not properly hedged, then yeah, you're going to lose your shirt. You're going to lose everything. And you see individuals like Dennis Gartman saying that this is going to create a lot of pain, this and that. Well, at the same time, you should have no business leveraging yourself to that extent. I mean, I don't think there should be caps on the leverage. What I'm saying is that if you're dumb enough not to be hedged and you're putting all this money at stake, then you deserve to lose all of it. I mean, there's nothing wrong with leverage, but you got to make sure that you are covered or you have a hedge to protect yourself. You need to have some risk tolerance involved. But for those individuals like Gartman and all these guys on Wall Street, really cocky, praising central banks, this and that, you never see these guys talking about situations like this. I mean, they always complain that, hey, the central bank was stupid, this and that. They never talk about the system that they're in, and they never talk about, hey, maybe these guys shouldn't have been leveraged 50 or 100 to 1. I mean, I don't see these traders being cocky after you heard that, and you're probably going to see more of these events. The Danish central bank is probably next online, but we shall see whether they remove their peg. And what about the other pegs that no one's talking about right now? Ultimately, fundamental analysis will always prevail in the long run. Short term, you could get by technical analysis, but once again, these cocky traders will never tell you that fundamental analysis works. Well, it did this time around, and those individuals who were leveraged to this extreme, well, tough luck. Anyways, guys, thanks for listening, and I'll talk to you later. Bye.